someone that has significant influence over an investee or over an organization is going to have a different type of accounting being done on recording the value of the stocks and also reporting the earnings than somebody that has insignificant influence over an investee or an organization. So someone that has significant influence, they're going to use what is called the equity method. And the equity method are for investors that are in it for the long haul. They're investing in a business for the long term. And that's the difference between an insignificant or somebody that has insignificant influence, because those people are probably more than likely are not going to be in it for the long haul, because eventually they may get bought out. So someone that's has significant influence, they're going to be using a different method than somebody that doesn't have that much influence. So that's the difference there. And someone with significant influence, they're going to use what is called the equity method, which is a method that is used for long-term investments. So we're going to say that, for example, somebody that has significant influence bought shares that cost $70,000. And we're going to say that this occurred on March 1st. So I'm going to put on here the date on March 1st, the account, DR for debit, CR for credit. So we're going to say that the acquisition of shares of $70,000 occurred on March 1st. So we need to reflect this in the investor's book with significant influence. So the account that's going to be credited is going to be cash for 70,000, because cash did go out to buy shares. And so since it was to buy shares, and since the investor has significant influence and they're using the equity method, the account that's going to be debited is going to be called equity method investments for 70,000. All right, I need to kind of align this better. There we go. Okay. So even though the name of the account is called equity method investments, so you have the word equity here, that is an asset account, but it is specifically a long-term asset account. So just to provide clarity there. So let's say next on March 31st, that the company made $500,000. Okay, now I'm going to have to get my calculator out. We're going to say that the company made $500,000 in income, which means that you are going to get a percent. Now, I didn't disclose this at the beginning. Since this person has significant influence, 20 to 50%, we're going to say that this investor has or owns 30% of the company. So we're going to say that the company generated income of $500,000. And out of that $500,000, 30% is going to go to this investor, since they own 30% of the business. So 30% of 100 or of $500,000, I actually was going to give that amount out. It should be $150,000, but let me just check my math real quick. So 500,000 times 0.30, yep, $150,000. Okay. So now what this investor has to do is they have to report the earnings. Now, since they're using the equity method, the account they're going to have to debit is going to be the same account that's debited as of March 1st, which is going to be equity method investments. And that's going to be for $150,000. So that's going to increase this asset account, even though, again, the word equity is in this account name. All right. So the other account that's going to be affected is going to be an account called earnings from equity method investments for that same amount. Okay. So this is the investor share of the company's earnings as of March 31st. Now, let's say that the company paid out dividends, because earnings and dividends are different as far as how you account for it. So let's just say that the company pays out dividend to an investor that has significant influence. So as you can see here with somebody that has insignificant influence, that paid out dividends as of March 31st over here. The person had to, or the investor had to debit cash and credit dividend revenue. So for somebody that has significant influence and that's using the equity method, we're going to say that this happened on March 31st. Keep it simple. And the company paid out a total of dividends in amount of, let's just say $20,000, which means that these dividends, I'm going to put on here, dividends. This is in total, which means that out of 20,000, we're going to take 30% of it, since this investor that has significant influence is going to take out 30% of this. And so 30% of 20,000 should be $6,000. Let me just double check my math on that. So 20,000 times 30%. Yes, that's $6,000. And so what this investor has to do, they're going to go ahead and debit cash, because they did receive cash in the form of dividends for $6,000. And the account that's going to be credited is going to be equity method investments. So this is going to reduce this asset account here by $60,000. So you see here that there's a difference in the accounting between someone that has, or an investor that has insignificant influence versus someone that has significant influence. Again, one main difference is that someone with significant influence is actually using the equity method, because the equity method is a method that is used for someone that's in it for the long run, which is why equity method investment, that is a long-term or a non-current asset account. Now, just to summarize what happened from March 1st to March 31st, we see that the equity method investments here account started off with $70,000. That's your balance sheet. Then on March 31st, it increased by $150,000. The earnings from equity method investments, that's your earnings, so that's going to affect your income statement. And then also March 31st, the equity method investments went down, so it decreased by $6,000, reflecting the cash that was received or paid out for the dividends that was earned.